Hello and welcome to the Smart Property Investment Show. Coming up, APRA's influence on off-the-plan sees investors scrambling, the banks team up and slap investors with a rate hike stick, and what's this marching over the horizon? Not one, not two, not three, but 4 new hotspots. All this and more in this episode of the Smart Property Investment Show. Hello and welcome to the Smart Property Investment Show. I'm Andy Scott. I'm publisher with Smart Property Investment. I'm joined as always by Phil Tarrant, even property investor and managing director of the title. Hello, Phil.
Hello, Andrew.
How are you today?
I'm very well, thanks.
Our special guest this week is a multi-award-winning mortgage broker, Ross LeCain, who is principal at Aussie Parramatta. G'day, Ross.
G'day. Thanks for having me.
Not at all, mate. How are you today?
I'm great, mate. Sun's shining. Month till Christmas. All guns firing, mate.
Just run us quickly so everyone knows. What
we've been the number one Aussie franchise the last 4 out of 6 years. We were the Australian Mortgage Broker Best Franchise Office in the Better Business Awards last year, and also in the Australian Mortgage Brokers as well, with the top office there.
So you're pretty good, is what you're saying?
Bloody good, mate.
Nice. And your office smells of rich mahogany.
I think also, Andrew, for disclosure, which I'm all about, Ross is also my mortgage broker, and I think he's your mortgage broker as well.
Ross is my mortgage broker as well.
He's also a good friend of ours, but mate, this guy's at the top of his game. He's in the Andes, so I think he can lend us some really good insights into what's going on in the market today.
Absolutely. And look, with that further ado, let's crack onto it, gentlemen. Have a look. Look, the first story I guess we'll look at is APRA's influence on, I suppose, it's really relating to SMSF investors in off-the-plan stuff. This came from Peter Restevsky. Apologies if I got your name wrong there, Peter. An account partner with Chan & Naylor out in Bankstown. Look, he's also a councillor on Liverpool City Council. He said that he's already witnessed clients' investment plans become affected by the lending changes, which began trickling down during the middle of the year, with 5 clients having to abandon their purchases. He goes on to say that so far we've been lucky in that respect, but once the property market starts declining, I don't think we're going to be as lucky. Look, we've only had, I suppose, APRA changes coming through in the last couple of weeks or so. Look, perhaps starting to take a bite. Ross, any of your sort of clients been caught up in this sort of stuff so far?
Look, most of our clients buy existing properties. We do have a few that are coming up. It's only just starting to take effect. So really in the last 6 weeks, we've seen the pre-approvals expire from the old APRA changes. So moving on from here, we expect there's going to be a lot of fallout. For your average property investor, and as I say, I deal with lots of property investors who have multi-million-dollar portfolios. So if a client has $1 million in debt, to qualify for the same loan, they roughly need to earn an extra $40,000. So you can imagine someone with a $3 million portfolio, that's $120,000 extra income they need to show. So they're just not getting those types of pay rises.
So it's not necessarily clients' positions have really changed in terms of the money they've got coming in, other assets and stuff they've got. It's just literally because the banks have changed what the rules are. If they haven't got through that approval stage to go, yeah, the banks have given them the money, the banks have gone, well, yeah, we're reassessing how much we'll lend you now, and you're going to need to pony up some extra cash for us.
Yeah, exactly. APRA has gone in, all the deposit-taking institutions have a level that they need to assess at, so that bench rate is around about 7.25% on principal and interest. So you imagine most investors, and we encourage all of our investors to pay interest only, especially while they've got an owner-occupied mortgage, because it just makes sense. So these guys are paying interest only at, say, 4.5%, so that's $45,000. They're getting assessed as if their repayments are $86,000. So that's where the $40,000 comes in that I'm talking about.
And if you are an investor in this, I suppose, these specific positions or similar ones where, because we're starting to see this with, I suppose, the APRA changes. As an investor, what options do you have? I mean, you said you need to find extra deposit. Is that is that the only course of action? Unless you can, as I said, get this extra cash, you're in trouble.
Yeah, the best thing to do is, sit down right now. Don't wait until your property is a month when you get the notice, but a month before it comes off the plan. Talk to your mortgage broker now so you can devise a plan. So many of our clients, as I say, have other assets, other portfolios where they can raise that extra deposit. If it's in regards to serviceability, there's some specialist lenders that are still assessing the loans not under the APRA guidelines, so there may be some opportunities for them to qualify for a mortgage with a specialist lender or a second-tier lender.
I mean, Phil, you hear, I suppose a lot of this talk specifically is about, I suppose, the off-the-plan units coming through. Look, there's a lot of units going up in potentially that part of the world. I mean, you hear there's all these units coming on board. You hear that Ross is telling us there's going to be people who are going to have difficulties with getting this stuff serviced. I mean, look, as putting your investment hat on, does that mean, do you sit there and think, great, there's going to be all these opportunities coming with people desperate to sell, I can go in and make my money going in here buying cheap stuff? Or do you think, that market is going to be depressed for a long time? There's a lot of stuff coming on, regardless of whether it's an off-the-plan, a unit, or a house and land package. I mean, how do you sort of see this affecting, I suppose, your purchase decisions as an investor in those areas?
Well, with an investor hat on, I'm an opportunist. I will find any opportunity I can which gives me a competitive advantage over anyone else to acquire a property either under market value or at a cheaper rate than what everyone else is willing to pay. So I'm always out there in the marketplace using the people I know as well. I've got a good buyer's agent, and I'll go and find those opportunities and find people who are in distress, and that's typically where I'll try and buy a property. So if I can locate and identify a property that someone needs to shift really quickly, and before it hits the market, I'm going to grab that really, really fast. So I'm looking at this here now in terms of off-the-plan purchases. If people aren't able to settle on these properties when they come due, what's available to them? There's a couple of things. They can either try and move it to someone else to take on the liability at that point in time, or they've got to find the financing to do it. And as Ross said, there's some other ways that you can secure financing for the interim periods and et cetera, et cetera. My concern around this is that, these new APRA requirements have come in place, and I think a little bit too late to try and temper some of the increase in pricing, particularly in the Sydney market, around investors in the marketplace who are putting upwards pressure on prices, which is creating these overinflated prices and hence a property bubble, which I don't believe in. But is Sydney market in particular overpriced at the moment? Look, it's not going to grow a lot more. Is it going to flatline? Probably. So all of these guys who have got into off-the-plan purchases have a double whammy of, yes, they've got to find the money to settle on these properties, and these changes in bank lender requirements means they may struggle to do that. But then there's the other component, and I say it's even more important, is it actually a good investment? Are these things going to go up in value that they've purchased or they're settling in a year's time, considering the market in Sydney? Now, we've got to remember across Australia there's markets within markets. Sydney might be flat, and Ross, you're probably better to talk about this, and Sydney might not show a lot of growth moving forward, but there's other places in Australia which are showing great market conditions for investment, whether you're investing in off-the-plan purchases or you're purchasing established stuff. And I guess it comes back down to, you need to look at the grade of the investment that you're purchasing, why you're purchasing it, what you're going to do with it over time, and how you're going to finance the bloody thing. And that's why you need a good mortgage broker now more than ever before.
Well, it comes down to timing, doesn't it, Phil? In terms of, there's people that have done really, really well in terms of over the last couple of years, with Sydney growing at a rate of about 40% over
that's ridiculous.
Over that time. I think I saw something the other day, since 2009, the GFC, RP data reported Sydney market's gone up by about 72%. So depending on what your time frame was, some people have obviously done really well. If people were entering into contracts now off the plan, I might be concerned, given that there's a good chance that we'll see properties coming off over the next sort of 12 months. Maybe a different story.
I don't know. What do you reckon, Andy? What are you hearing from your guys and people in the marketplace?
Look, I think I think the thing that people look, the way that we invest, we are, you and me personally, Phil, we have a similar sort of tactic and strategy. Some others don't. Some other people like the idea of buying something that's off the plan. You know what? I'm going to put my money into it. It's going to sit there over 10 and 15 years, not going to cost me much to hold, and someone else is going to pay it down. It's going to be worth something, And the perception being it's off the plan, it's brand new, it's going to be hassle-free. They're not going to get annoyed with, the calls that you and I get from our property managers that a $500, carpet needs replacing, or the showers, the doors have fallen off the showers. That's one I got the other day, which is nice to hear. So you've got things. So some people like not having that, but I think, look, ultimately, again, it comes down to you need to be able to be prepared to be able to give yourself wiggle room for whatever your strategy is. I think that's sort of clear. I mean, these people, for whatever reason, don't necessarily have wiggle room to do that. And I think that's where the problem happens, when you push to your limit and you don't see yourself a buffer.
So the summary of this is contingencies. Make sure you've got some ways to manoeuvre depending on the situation, whether that is alternative financing, whether it's some way you can offload the property before it becomes due. Is that a good way to sort of summarise where we are with this story?
To understand the investment that you're getting into at the time of investing, and be prepared in cases like this.
Yeah. Well, look, times change and things change, and I can't think of a better segue to move through to the next thing that popped up across my desk the other day that was getting a lot of popularity. Investors getting slapped with the rate hike stick by a majority of the banks. This is something that got flagged a while ago, but it came into effect a few days ago. 13 banks enacted increases on their variable rate home loan products on Friday, and of course that sweep up all investors with stuff of that as well. Around the rate hikes, look, we're at historic lows with regards to sort of the RBA rate and the cash rate in this country, and with sort of lending rates. I guess the only way is that, in that regard, look, is this something that we're seeing, I suppose, the banks breaking step with what the RBA are doing, and what does that mean to us as investors? I mean, we've spoken about APRA at the front end, but is that banks just being friendly, using conditions to just jack the rates up on all of us and take an extra bit of cream off the top?
Well, there's a real appetite for owner-occupied mortgages, and we're seeing that from all the banks because of the APRA guidelines. And the guidelines stipulate that they can't grow their investment portfolio, so that's the number of investment mortgages on their books, by more than 10%. So these loans are very profitable to the banks. Banks want to write them, but they want to stay at that 9.99%. And so we have seen lenders moving rates on investment loans, some more than others, so they get within that balance. They get around that 9.99% cap. I mean, a few lenders have come back into the market. So AMP has come back in the market for all bar SMSF this week, and Bank West has also come back in the market. So they dropped out mid-year, and they're coming back into the market, which shows their volumes of loans are coming in line with that cap. So before they were quite aggressive, so now they're in line with the cap, and you'll see that. I mean, St George, for example, offering a cashback for investors to entice them. So obviously, with the rebalancing of their portfolios, a lot of people originally took out investment loans, and now they've gone to the banks with the change in their interest rates to have those repriced. So they're now getting owner occupied. So that has freed up quite a lot of space under this cap. So banks, some banks have that appetite, but it'll be a month by month thing depending on how close they are to that 10%.
I mean, look, I suppose in my experience of banks here, they never miss an opportunity to explain that their costs and stuff have gone up, and so consequently their shareholders have to feel a bit of pain, and their customers have some bit of pain as well with sort of, inevitable price rises and stuff. Phil, your customers are probably your tenants, aren't they? You're getting a bit of pain with the rates going up, so what, rates up, rents up? Is it as simple as that for you?
Like most things in life, I concentrate on the things that I can control, and I don't really concern myself too much with the stuff that I can't control. I can't control what lenders are going to do with interest rates. I'm like anyone else. What they say goes, and I've got to work within that. Now, that said, I do have certain mechanisms I can use to influence my mortgage. I can look to refinance it if I'm not happy with it. I can try and find cheaper rates somewhere else. Obviously, there's costs associated with that, as you know, Ross. Or I can just suck it up and go, all right, at the moment, my money's going to cost me this to lend, to borrow. and I'll just pay that out. So, am I moving on as my interest rates goes up? Am I looking to increase my rentals? Yeah, sure, of course I am. I'll do that whenever I possibly can. But that's really a dialogue with my property manager to say, what's the appetite at the moment for rents in this particular area, and can I stick up my rents without losing my tenants? And you know what? Over the last sort of year or so, most of the time they've gone, nah, just keep it as it is. You can't shift it because there are so many investors in the marketplace buying investment properties in the same areas, and there's too many investment properties in the marketplace right now, so there's no upward pressure on rent. So just be thankful that you've got someone in your property right now. Shut up, sit there, pay your mortgage, don't worry about it. Now, for me, this goes back to, and this is the number you use, that banks are assessing on 7.25% P&I, right? Yeah. When I look at my ability to pay my mortgages, I always try and look at it as in, what can I spend if rates go up to this particular amount, and am I going to be able to sleep at night and make sure that I'm not going to be worrying about money? And that's my benchmark for everything. I don't want to be sitting there worrying about paying my mortgage. I want to know that I can do it comfortably. So when I look at purchasing property for investment, I look at what is my capacity to lend if rates go up. And I look at it that way. So I'll use the word a contingency. So I know that even rates go up 1%, and you don't know what's going to happen in the future. Ross, when's the next interest rate rise? I'm not going to call it, but I'm going to leave that one for you, but I'll leave it.
Do you know, Ross?
I don't know.
I thought you had the RBA on the phone.
The economists get it wrong, they study it.
The message is, rates are going to go up, rates are going to go down. As an investor, you need to be comfortable that should rates go up 1%, 2%, that you're still going to be able to put food on the table.
I mean, is that, I suppose Phil sort of hit on a point there, Ross, is that, I mean, I suppose the question is, rates have got, the bank rates have gone up, so do your rents go up? It's that sort of reactive thing. But Phil sort of hinted that he has more a process of review of how he looks at stuff anyway. Is that sort of, from your sort of, with your mortgage broker hat on, and look, obviously with your hat on as a property investor as well, is that where you see it, that these things happen, it doesn't really matter, it's about how you have a regular review and what you look at, and to know what your position is, really, to know really what your options are.
If you look at it, over the history of time, in terms of we started our mortgage broking business in 2004 after a similar boom, and rental yields went to similar levels where they were today. And then as the market flattens out and there's less people buying investment, the demand changes for rental properties. So as it's a supply and demand thing. So as the demand for rental properties increases, then rents are able to go up. At the moment, as Phil touched on, rates have been low. There's been a buying frenzy. There's been a construction. We've seen more construction that we've ever had. So there's more rental properties on the market. So it makes sense that rents aren't increasing at this point in time. Given what we expect to happen over the next couple of years, I think you will see that change, and as there becomes less properties on the market, your rents will tend to increase. It's basic economics.
So we've been a bit Sydney-centric here because I invest right across the country, as do you, and but I feel like we've been a bit Sydney-centric. But the reason why I think at the moment is that we come to that point in all property cycles where it starts to get flat. So investors have been highly active in the Sydney markets, in particular, out sort of western suburbs, southwest suburbs, where there's been some great opportunities for capital growth. So all the investors have bought a lot of properties out that way, and that's had some effect on pushing prices up. How much of the hike in prices in your Mount Druitts or your Campbelltowns of the world is driven by investors? I'd argue quite a lot, because it's a sentiment-driven thing. But at that point right now, where APRA is stuck in these new requirements, it's slowed down investor activity. Give it a tick, it needed to happen. Now you've got a stabilisation period where with the less investors in the marketplace, it's going to take a little bit of heat of that market. It's not going to be the competition for properties as there is. Therefore, prices will stabilise, which means within a year or so, maybe 18 months, I'm going to start looking to lift my rents up in those areas, because that's the natural cycle that happens.
Yeah, I think you hit on a good point. It's about having a chat to your property manager and seeing what's on the market. If, for example, a 200-unit complex has just come on the market and purchased predominantly by investors, there's 200 units that you're competing against that your property is. So it's a really market-by-market specific thing. I mean, a good time in terms of this time of year is to look at not having your leases renew around Christmas time. So look, rather than doing a 12-month lease, look to do maybe a 14-month lease. So your lease is expiring around February because it's harder time to get tenants in the property around December.
So question for you on that, Ross. So if I use management agents to look after my stuff because I don't have the time or inclination to want to run out and fix someone's washer, right? Cost me whatever percent of this a month. If you don't use a managing agent to look after your properties, how do you know as an investor whether or not to stick your rates up or when to review or what sort of lease terms are set? What do you reckon?
Yeah, a great tip that someone told me was every time you get your rates notice, use that as a cue to jump on realestate.com.au or Domain and just have a look at what the market rentals. Compare similar properties to yours and see what level they're being rented at. And that'll give you a good guide if you're managing your own property to see where the market's sitting at that point in time.
Rolled gold.
There you go.
Well, look, I know you mentioned that we're talking about Sydney, a little bit Sydney-centric. I guess that's with some of the news coming up, but I'm going to blow that out of the water now by actually talking about Sydney again. Phil, you mentioned that you thought Sydney was a little bit flat. Ross, you didn't look mad keen on it. You're both wrong. That's not my opinion. That is the opinion of Angus Rain. He's the executive chairman of Rain and Horn. This comes on the back of the New South Wales State Government this week confirmed the location of 6 new metro stations across the city CBD and North Shore, with new stations particularly to be built at North Sydney and Crow's Nest. Mr. Rain identified a couple of areas, Crow's Nest, Camperdown, Newtown, and of course North Sydney. Reckoned that he will be looking at, jumps of between 5 and 10% following the announcement, to paraphrase him. Phil, we're based in North Sydney. We love a hotspot. Have you noticed the pavement beneath your feet warming as you've been walking out to get your lunch over the last couple of months?
Paved in gold. I like the and everyone, we're looking at a story on smartpropertyinvestment.com.au which we ran Thursday of last week, which says prices in 4 suburbs set to skyrocket. And you know how much I love the word skyrocket. I don't know what it means. Is it a rocket? Is it a skyrocket? Is it a spaceship? I don't know. But as you know, Andy, I like these stories, but they also make me a little bit nervous. Hotspotting, it's probably up there with the AFL in terms of a national pastime. Everyone likes a hotspot, me included, but I typically don't talk about my hotspots because they're the ones that people will be talking about in 3 years' time, and I've already been there and gone. So I'll frame this within the sort of realm of just be careful with hotspots. If people are talking about hotspots, maybe they're not so hot. You need to find your own hotspots, and you can do that by doing a whole bunch of different things, but it's basically looking at the fundamentals. So, but I'll talk about this hotspot because I do like a hotspot, as you know, Andrew.
Indeed.
So, to your point, is North Sydney paved in gold? Well, it's paved in new paving stones. So our Coles has just opened up just up the road, which I'm very happy about because I get a barbecue chicken there at lunch with some bread rolls for about $4.50. So that makes me very, very happy. But I found that really interesting because I would imagine that Coles stipulated by taking on that lease that they needed to get a refurbishment of Walker Street in North Sydney. So that's happened and it's all aligned and it's very nice, and it's injected some lifeblood into North Sydney, particularly on the weekends. I was up here on Saturday buying some groceries, and there was actually activity here. There's stuff going on. What did annoy me, though, was that the locking mechanism on the trolley meant that I couldn't push the trolley outside of the front door, and I had a small toddler there with a big whole bunch of shopping in my car down the road. So I wasn't happy about that. But anyway, I'm not gonna complain.
You won't make that mistake twice.
No, I won't. But it's good to see the state government giving some actual concrete projections on the allocation of investment dollars. Obviously, the growth of this great city and this state is dependent on infrastructure. And as a property investor, you need to be looking at these things constantly to work out where's the next best place to invest. Now, the cynic in me, so this is not me as an investor, this is me as a journalist, which, as you know, is my passion, Andrew.
It is your passion.
And it means that I am a cynic and sometimes a grumpy, miserable old git.
Also your passion.
It is a passion of mine. I remember about 10 years ago, I was living in Balmain, and I was looking at property to buy, and I got really excited when they announced the new tube, which was going to be developed, and there was going to be a spot underneath Rozelle, where the Tigers was at the time, where they were going to build a great news station. I got really excited about it, thinking, brilliant, I don't have to take that bus into the city over Anzac Bridge every day. Great. You know what? It didn't happen because some of the blokes in government said, nah, let's not do that now. Let's do something else. Let's spend our money on something which doesn't really service the rest of the good people of Sydney. So I look at this and I think, big tick to the New South Wales government by saying, yes, create a metro project. Is it going to happen in my lifetime? No. I don't believe this is going to happen. If it does, I'll eat my hat. That seems to be a common term that we use around here. But look, if there is concrete plans that this is going to happen, and it is actually going to happen, I don't know how you're going to work it out. It's going to happen. I don't think anyone's going to put their hand up and say, yes, 100%, a metro is going to go in. Isn't it great and wonderful? They've talked about a second harbour crossing for trains for years and years and years and years. I would take this with a sense of cynicism and scepticism and think, if you want to take a punt and you want to base your investment decisions on this particular thing, yeah, you know what, it's a bit of a risk. That said, North Sydney is a stone's throw from the Sydney CBD. Crow's Nest is a stone's throw from the Sydney CBD. The whole area up here, this sort of lower North Shore, is a stone's throw from the CBD. You're probably not going to go too wrong investing in this area. You might pay a little bit too much for a property right now, but if you're happy to sit on that property for 20, 30 years or pass it on to your children, you're probably going to make a few bucks out of it. So a tick for investing in this area, but should you be investing in this area because the state government said it's going to build some infrastructure? Yeah.
What about you, Ross? I mean, look, we spoke about, as Phil mentioned, we love a good hotspot story here at Smart Property Investment, and it's entertaining if nothing else. But are you from the school of that you can genuinely glean something from these sort of stories, or are you from the school of, well, if buffoons like me and Phil are talking about it, then the opportunity for good buying has
You're too kind, Andrew.
I must say I do love a good hotspot article. I always have a look and have a read in terms of where they're saying. But
it's the Kardashian story of the property investment industry.
It is.
It's you don't want to, but you can't help.
Mate, how to break the internet, Andrew?
Phil and I were at a seminar the other day, and the figure bandied around was the property market in Australia there's $6.2 trillion worth of residential property, which you compare the share market, it's about 1.5 trillion. So it's a massive market. So there's always going to be markets within markets, and I think it comes down to sometimes street by street or even house by house. There's some people that are going to be winning, and there's going to be the losers as well. But in terms of this particular North Sydney, obviously North Sydney is located, all these properties located within that 10-kilometre radius of the Sydney CBD. Long term, over 50 years, it's going to be a place where your money's going to increase. As for rental returns and building a sustainable portfolio, that comes down to affordability. And as mortgage brokers, we're constantly looking at affordability. And affordability is something you have to take into consideration in terms of how quickly a market is going to move. I mean, being around these types of areas, I would consider that's your more well-to-do families and so forth. So the levels of income are probably quite high, but it's something I'd definitely be doing some more research into to make sure that the affordability is there to sustain these properties in the long term.
Great stuff. Well, that's about it for this week, guys. Any final thoughts, Phil Tarrant?
Well, next time we do this, I promise to be less Sydney-centric.
There we go. That's not New Year's, you don't have to make...
No. That's
you could have said that when we weren't recording, but that's okay.
No, that's all right. That's our commitment to our listeners to cover all markets right across Australia, opportunities good and bad.
Ross, thanks for coming in today, mate. Any final nuggets of, I suppose, wisdom that you can glean from your experience of, helping lots and lots of investors? I mean, if you had to give someone sort of 3 bullet points of, look, you should always be making sure you're doing this when it comes to your property investment finance, in a nutshell, what would they be?
Yeah, I think, from a general market sense, there's always somewhere to invest. So, Phil and I are currently buying properties in the market, looking in the Brisbane market. So there's always opportunities, and there's markets within markets around the country. So don't focus on where you live or feel that you have to be able to drive past the property. But from a financing point of view, look after your cash flow is the most important thing. So rental yields and your ability to make those mortgage repayments is very important. Set up buffers like 50 grand sitting in an offset account, something that's going to help you sleep well at night, and don't sail too close to the wind in terms of your serviceability. Like, don't go out and buy 3 or 4 off the plan properties, because you don't know what that's going to mean down the track. So really look after, have those buffers in place, so you've got that protection should something else happen. And look to buy, as Phil said, look to buy those under market properties as well, because in times of trouble you can always sell it and get out of the market.
Thanks, Ross. Well, that's all for us this week. Guys, again, thanks for coming in. Remember, everyone, look, you can find all the latest news and opinion and the sort of things that we and all other property investors are talking about on www.smartpropertyinvestment.com.au. We've also got our sister site, which is www.whichinvestmentproperty.com.au. Come along, subscribe. If you've got any feedback for us here, look, you can email me on publisher@smartpropertyinvestment.com.au. Any other contact details, you'll find them on the site. Thanks again, guys. Speak soon.
Thank you.